Welcome back to Switzer on Australia's Business Channel. Well, here on Switzer, we're all about helping you make the most of your money. We ask for your questions and try to answer them in as many as we can. Tonight, we're going to help one viewer who wants us to explain in detail how to value a company. How do the experts figure out what a share price should be, and how do they judge whether it's likely to go up or down in the future? Roger Montgomery is one of Australia's leading fund managers and has a knack for explaining this kind of stuff so everyone can understand it. Well, nearly everyone. Roger, welcome back to Switzer, mate.
If everyone can't understand this, I'm not doing my job properly.
That's right. So what I'm going to do is, I'm calling this Roger Montgomery 101 or Roger Montgomery for Dummies, okay?
Fine.
And so I'm going to ask any question where I think someone out there might be saying, hang on, I don't understand that.
Okay.
I'm going to pull you up.
All right.
And if that means bringing you back another show till we get it right, we'll get it right.
Fine.
Okay. So, valuing a company, you've always said, on one hand, when the share price goes up, that's just basically the market cheering up the price.
Sure.
But at the end of the day, you've got to weigh up the value of a company.
Okay. If you were going to buy a farm, let's go backwards here. Just put some context around what we're going to talk about here.
Yeah, good.
In 2006, ABC Learning Centre's shares were trading at $8, and I came out quite publicly and vocally, said that they were worth less than $3, and then shortly after that said, look, this thing's probably going to blow up. Everyone wanted to know, how did I know that? And that's what we'll talk about tonight.
Okay.
You know, and then how did I know that Foster's paid too much for South Corp, or that Wesfarmers has paid too much for Coles? How do I know those things? How do I know that, you know, if the Canadian pension funds want Transurban at the price they're paying, let them have it? You know, how do I come to those conclusions and as a result outperform the stock market fairly substantially? That's what you want to know.
Exactly.
It starts with the idea that we're not going to buy stocks. We're going to buy a farm, or we're going to buy a business. Okay. Now, if you're going to buy a farm or you're going to buy a property, what you'd want to know is, in the time that I own this property, how much is it going to cost me to maintain it? How much revenue am I going to get from renting it out, for example, or growing crops on it? And then after the expenses, what's my profit going to be, and what's going to happen to my profits? So it's basically the simple return on my investment. If I put $1 million into a farm and I get away with 20%, I'm going to get 10% on a rented property, I'll go to the farm. You sound like you've been reading. So that's very good. That's exactly what it is. Yeah. It actually comes down to something called return on equity. So what I want to know is, where can I get the highest return on equity? If I buy things with low rates of return on equity, then what I'll end up finding is, if a company, let's compare everything to a bank account. Okay. So I've got a bank account. In that, it's my bank account. It's Roger Montgomery's bank account.
It's a big bank account too.
Well, let's just say for the moment, for argument's sake, let's say there's $10 million in the bank account.
That sounds like real life too.
So there's $10 million in the bank account, and in that, and what I'm going to do is, I've got a special bank account. I've got a special deal with the Commonwealth Bank or whatever. They pay me 20% per annum for the rest of my life.
You must have some very provocative pictures on Ralph to get returns like that. Anyway, go on.
So I've got this bank account. It's got $10 million in it, and it's earning 20% per annum. Now I'm going to put that bank account up for auction. Yeah. Okay, and I'm going to auction it here on your program, and people can ring in with their bids. Yeah. Now, what's the rate of return you can get it on a bank account at the moment?
6%.
6%?
Yeah.
Yeah, okay, well, let's say it's 6. You know, we can talk about that after that. I want to know where I can get 6. So let's say I can get 6. Well, so an account offering 20 for the rest of my life, however long that is, it's got to be worth more than the $20 million in it.
Exactly.
I reckon if I auctioned it, someone would be willing to pay maybe $40 million for it.
Yeah, just half the rate.
Well, because they give you a 10% return, right? In simple interest.
Remember, there's normal people there. So by paying $40 million for this $20 million account, it chops interest rate down by half to 10%,
so you're
which is still better than the market.
Which is still better than you can get at the moment.
And this is what happens on bond markets all the time.
And I haven't talked about whether you're allowed to retain the interest and compound it and reinvest it in the bank account or not. If you are allowed to retain it and keep the interest in the account and compound it, it would be worth even more than one that was forced to actually pay all that interest out to you.
Out of the account,
right? Because pay it all out to me, I get 20%, but then I've got to go and find another bank account that's only going to get me 6. So it's not worth as much. So you'd pay more for one that keeps it.
You're doing a very good job, mate. Keep it up.
Right. So it's exactly the same with companies. So that bank account, well, let's say, for argument's sake, it's worth $40 million. But I turn the stock market on, and I find that these bank accounts are trading at $15 million. For whatever reason, because Saddam Hussein has done something, or Obama said something wrong, or the gold price is doing this, or inflation's expected to do that, whatever it is, these bank accounts, when I find them in the stock market, I can get them for $15 million instead of $40 million, which is what I think they're worth. Okay. So what should I do?
We should buy them.
I should buy those bank accounts because they're undervalued. Exactly. Precisely. In fact, I'm getting more than 20%. Well, I'm getting slightly less than 20%, but it's a lot cheaper than what I think they're worth. So I want to buy as many of those as I can get. Now, here's the thing that happens in the stock market. They're at $15 million. Okay, I buy them. They drop to 10. What should I do?
Buy more.
Buy more.
Because you believe
exactly.
it.
Yeah, because I know what it's worth.
I'm doing well here.
You're doing very well.
I'm not getting honours degree.
And here's the thing: you're not going to make money straight away because you can't predict what these bank accounts are going to do on the stock market on a daily, weekly, or monthly basis. But over time, I know that the price of those bank accounts will reflect their value.
Okay, yeah, you convinced us. Now, people at home scream at TV, Roger, tell us how we do that.
Okay. Yeah. There's a little formula.
Okay.
Right, there's a very basic formula.
Is it basic?
It is basic.
Okay, go for it.
It's the return on equity divided by your required return, or the return that you're looking for. Okay? So with the bank account example, the return we were looking for was 10%.
Yes, that's on the bottom of the equation.
Yes, so 20% divided by 10% multiplied by how much money's in the bank account. Now, when it comes to stocks or businesses listed on the stock market, what we're looking at is the equity per share, the equity in the business. Now, that's the formula for calculating, and I didn't make that up.
No.
I got that straight out of the 1981 letter by Warren Buffett to his Berkshire Hathaway shareholders. So you can all download that and you can find it there. It's not written out like that, of course. It's in text, but you can work it out. And so that's for a company and for an account that pays all of the earnings out. Or all of the interest out as a dividend.
Okay, so this is a company that at the end of the year, when the profit is determined, they divide it amongst all the shares and they get rid of all the profit. There's no retained earnings, is that what you're saying? Okay,
that's right.
Now, do you like companies like that? You like companies that do the opposite, don't you?
I'm happy to buy a company that has a high rate of return on equity and pays all of its earnings out as a dividend. In fact, I own a company like that, a company called Fleetwood, whose shares I bought at about $3.20 and $3.50. They've more than doubled. It pays all of its earnings out as a dividend. I don't mind doing that, but it's not worth as much. I wouldn't pay as much for that bank account as one that was able to retain the profits and compound it at 20%. Right? So I'm happy to buy either. I'm just not willing to pay as much for the first one as the latter one.
Why did you select Fleetwood? What was can you remember the equation that...
Yeah, I used that equation.
Exactly that equation?
Exactly that equation.
All right, so how can people find the return on equity easily? Or is it easy to find?
It is easy to calculate. It's the net profit after tax divided by the equity in the business. So they go... But the trick is, use beginning equity, not ending equity. Use the beginning equity because profits occur over a period, but it was the equity at the beginning that generated those profits. Now, some people do some fancy adjusting and some weighted averaging based on additional capital that's raised during the year and so on and so forth. And you can do that. You can do that with the retained earnings as well. There's a whole bunch of different things you can do. But that's the basic formula.
Roger, someone will be saying, but where do I find that information?
Okay. Well, if you subscribe to any of those online broking firms, they all get their data from either Morningstar or S&P or Thomson Reuters or whoever it is, and it's all there for you for free. So you just look up return on equity. You can, I'm sure some of them actually run searches where you can say, I want to find companies with a return on equity above 20%, and it'll spit it out for you.
Okay.